Quaker Oats is considering a $100,000 investment in a cereal filling machine for its plant in Kansas City. The fibber craze has spurred the demand for oatmeal to the point of exhausting plant capacity. If the machine is purchased, additional cereal sales of $80,000 could be made each year. The cost of goods sold is only $20,000 and the profits derived would be taxed at 30%. The increased sales will also require holding $10,000 in inventory. Quaker will partially offset that use of cash by increasing its payables by $8,000 to farmers for the oats and stone container for the boxes, to net a $2,000 additional cash investment. At the end of 3 years, the machine will be worn out, but the equipment will still be useful to a milling company in Mexico. Quaker plans to sell it to Molino Grande at a price of $10,000. The timing of cash flows. Quaker Oats filling machine project in thousands of dollars. In this example, the timing of cash flows is critical to determining the project's value. A commonly used representation of the timing of cash flows is a bar graph. Each period, cumulative cash flow is reflected either below the line for cash investments or above the line for returns. Example: suppose that the cash flows are the same, but the timing of the cash is advanced as follows, prolonged as follows. When the milling project produces cash, Quaker reinvests it rather than let it remain idle. Therefore, if Quaker receives $51,000, $51,000, and $61,000 as described earlier, the company earns income with the cash for 2 more years in scenario A than in scenario B. If the company has investment opportunities that yield 10%, then scenario A will produce $34,230 more than scenario B. The flows have an accumulated value at the end of 3 years of $163,000 plus earned interest of $34,230. That equals $197,000. A simpler calculation is to use the formula for the accumulated value or future value of a dollar. The accumulated value factors for 10% rate are: when evaluating projects or investments that extend into the future, it is not only the magnitude of the cash flows that is important, but also the timing and the subsequent use to which those flows can be reinvested. Net present value (NPV), accumulated value analysis, is a good tool to determine how much a retiree needs to invest today to have an adequate pension in 30 years. But it doesn't solve the problem of evaluating investments and projects today. Investments need to be evaluated in today's dollars. How much is Quaker's milling project worth today? How does it compare to a similar piece of equipment that costs $150,000 but lasts for years? Cash flow analysis determines the flows, and the NPV technique values them in today's dollars. In that way, different projects can be compared regardless of timing. If Apple Computer, for example, knows that a new Tangerine computer will be a surefire $100 million hit, but that it will take 10 years to develop, it may not make sense to invest in this project. Not only will that $100 million be worth less due to inflation, but Apple could also use the money to invest in robotics, which will save Apple production costs today. Even if an NPV analysis justifies the Tangerine, there may be strategic reasons that overshadow it. That's where the management judgment is used. Securities analysts see stocks and bonds as an equipment purchase. The stocks provide dividend payments, and bonds provide interest payments in the future. The securities' values lie in the present value of their future cash flow. Just as Quaker Oats uses NPV analysis to evaluate the merits of buying a new piece of production equipment, corporations evaluate new factories and the worth of increased advertising. Lawyers involved in wrongful death suits can use net present value techniques to value the total of an individual's future earnings when considering a settlement. The basic idea to remember is a dollar today is worth more than a dollar received in the future. The Quaker Oats project yielded $163,000 over 3 years, 51 plus 51 plus 61, as previously calculated. The $163,000 in cash flows would yield an additional $34,000 if the cash produced was reinvested at a rate of 10% in other company projects or an interest-bearing investment. Would you pay $163,000 for $163,000 to be received over 3 years? Of course not. You would be giving up the time value of money, or 34,000. Using this simple logic, NPV analysis takes future cash flows and discounts them to their present-day value. This is the inverse of accumulated value. The formula is as follows. Considering the 10% reinvestment opportunities available and the project's riskiness, $1 in the future is worth. The cash flows of the Quaker project would be valued in the following way. The evaluation of any project depends on the magnitude of the cash flows, the timing, and the discount rate, 10% in this case. The discount rate is highly subjective. The higher the rate or hurdle rate, the less a dollar in the future would be worth today. It is called a hurdle rate because a project with a higher discount rate must generate more cash in the future to be worth the same value of today. The project thus has a higher hurdle to jump to stay even. In cases where the future outcome of an investment is risky, for example, oil well, a higher discount rate is appropriate. If the outcome of an investment is certain, as in the investment in a labor-saving device or in a government bond, a lower rate is warranted. Companies not guided by an expertise of these techniques will use only one hurdle rate for all investment decisions, and thereby ignore the relative riskiness of projects. They end up rejecting sure things and chasing high-risk projects. Internal rate of return IRR. IRR is a derivative of NPV. Simply stated, IRR of an investment is the rate at which the discounted cash flows in the future equal the value of the investment today. To find the IRR, one must try different discount rates until the NPV equals 0. For the Quaker project, the IRR is 26.709%. To confirm that number, we can calculate the following. Using IRR to rank projects is useful, but it does not consider the magnitude of the values. A small investment with proportionately large returns would be ranked higher than very large investments with adequate returns. Ranking by IRR also neglects the hurdle rates or discount factors used in NPV analysis. Those hurdle rates adjust for risk. All things being equal, the investment in equipment by Quaker may have a lower IRR than highly speculative research into a Swedish cancer cure by Merck, but the Quaker project could have a higher NPV. The equipment project's smaller cash flows would be discounted at a 10% rate because of the lower risk involved. This could result in higher NPV. The cancer research would be assessed using a very high discount rate of 50%. The higher the discount rate, the less the cash is worth today and the more risk is implied.